All right, this is where we left off talking about the basic idea of deferrals and accruals. Cash coming before the revenue expense is referred to as a deferral. Cash coming after the revenue expense year-end recognition is referred to as an accrual. Okay, so let's get into some examples. The first one we're going to look at is deferred expenses. All right, you could also refer to as prepaid expenses or prepaid assets. A very typical prepaid asset, well, I learned it in school as a prepaid asset. That made sense to me. It's something you prepay in advance of using it. All right. Your book often refers to as a prepaid expense, which I think is a little bit confusing because I don't want you confusing it with an actual expense. All right, but a prepaid asset is just that, when you pay for something in advance, all right, or a deferred expense. And we said back here, when cash comes before the revenue expense, it's a deferral. That's what this is. Okay, let me get to the actual example here. December 5th, before year end, Atherton Plumbing purchased $250 in supplies, right? So the original entry would have been a debit to supplies because you get supplies, you increase the asset account of the supplies, and a credit to cash because your cash goes down. Okay, so let's put that into a T count because we like to see things like that. You get a debit to supplies, $250. Now let's look at the adjusting entry down here. It says as of December 31st, only $50 of supplies are left. So we had $250, we used some during the month, and we have $50 left over. So if that's the case, what we have to do is we have to credit. The adjusting entry is to reduce the supplies account by $200 so that now supplies is 50, which is correct. That's the amount of supplies I have left. So this right here is part of the adjusting entry, this credit to supplies. Our debit, because we had to use those supplies to run the business this month, our debit is to supplies expense. Okay, so that is our adjusting entry for this prepaid asset. You get a debit to supplies expense, credit to supplies. Now, one thing I want to call out about all of these adjusting entries is here are a couple of rules. Adjusting entries never involve cash, and adjusting entries either increase revenue or increase expenses. In this case, we're increasing expenses. The whole point of this is that we're making the supplies account be the proper balance, number one. Number two, we're recording the expense against the revenue of the period that we earn that period. We use $200 in supplies, we have to record the expense of using those $200 in supplies. Okay, let's look at one more example of a prepaid expense. On December 1st, Atherton Plumbing purchased a 6-month insurance policy for $600. Okay, so we've got the original entry would be a credit to cash. I always like to start with cash because it's easy to think cash goes up, cash goes down. In this case, credit to cash, cash goes down $600. You've got a debit to prepaid insurance for $600. That's your prepaid asset or prepaid expense. Okay, so let's draw our T account, prepaid expense. We've got $600 there. And now let's look at our adjusting entry. As of December 31st, 1 month of that has been used up. 1 month of time has passed. It is a 6-month policy. So we must have used up how much? $100 worth, right? So we are going to reduce the asset account of prepaid insurance by $100 because that's how much we used because time has passed. And our new balance in prepaid insurance is $500. And our debit is to insurance expense because we used it. We had to use insurance. Well, we had a cost of insurance this month. That is the matching principle. We're tying the expense against the revenues of the period. Okay, and I'm just kind of repeating my rules here as we go along. All right. I can't ask any questions because, that's not how this works. All right, let's look at the second type of deferral, deferred revenues. Okay, let me say something. The cash, let me go back for a second. The cash here is in advance of the expense, right? The fact is we put out the money, we had the asset in advance of the expense. That's how that timeline worked at the very beginning of this. Okay, deferred revenues, same thing. The idea is cash is coming before the actual revenue or expense recognition on December 31st. On November 1st, Huber Rental Properties received 3 months of rent in advance of $2,400 for one of its commercial properties. Okay, so on November 1st, we, being Huber, got $2,400. So let's start with the easy part of it. We got cash, $2,400. Always start with cash if you have that chance. And we owe them the service of allowing them to rent our property. So we have a liability to them of unearned revenue. Remember I said unearned accounts, unearned revenue is a liability. It means you owe someone something. In this case, you owe them the service of renting your space. Okay, so we have this credit here to this liability of unearned revenue. So let's draw our T account for unearned revenue, put our $2,400 in there. Right, it's a liability. Now the idea is after it's November 1st, so now they rent our property for November and December, 2 months, right? So that's going to be $1,600 worth, right? Because it's 3 months, 800, 800, 800, 800. So as of December 31st, 2 months worth of this rent has been earned. So we let them rent our space for 2 months. So what we'll do is we will reduce our unearned revenue by $1,600 here, okay? Because that's 2 months worth. We no longer owe them 3 months worth of service. We only owe them 1 month of service. So we're going to subtotal that. We only owe them $800, and they're going to rent our space in January. That's fine. That is our liability going into January. So we've got a debit to unearned revenue and a credit. Guess what? We just rented it. We just did our job. So we get to call it rent revenue. Okay, so we've turned from a liability where somebody gave us cash in advance and then we did our service. So now it's no longer a liability. I don't owe them anymore. I'm earning it. I earned that money that they gave me. Okay, so there we go. My little box that keeps popping up there. All right. One more example here. The balance in the unearned revenue account before adjustment at the end of the year is $7,000. It says journalize the adjusting entry required if the amount of unearned revenue at the end of the year is $1,500. So they're just telling you. They're not making you do any math here. They could just do this too. They could tell you that the balance of unearned revenue is $7,000. And they'll just tell you at year end, they know they still owe $1,500 worth of service. So how do we get there? We debit unearned revenue for $5,500. We credit revenue for $5,500. Okay, so in this case, they just told us what the beginning balance is and what it should be. So we had to figure out how to get from the $7,000 to $1,500, and that was with a $5,500 debit. That's why I like the T accounts. I think they're really useful to see this. All right. Let's move on to the flip side of things, accrued expenses. Accrued expenses mean the cash is coming after the revenue or expense recognition. So let's see, assume that on December 31st is a Wednesday. This is a very typical type of an accrued expense. On that date, Huber Rental Properties owes $500 in salaries to employees. These salaries will be paid on Friday, the usual payday. All right, so I like to break this down. Let's put on a timeline. You've got 2020, you've got 2021, Monday through Friday, right? Monday through Wednesday, Thursday and Friday over here. And December 31st is on a Wednesday. So if you think about it, they owe $500 in salaries to employees at this point. That's what they said. The point is that we have to make sure this $500 in salaries that we owe gets reported in 2020, even though Friday is payday, right? So we have to make sure these expenses are accrued in the right period, right? The cash part is going to come after the revenue or expense recognition. So, right, there's your salaries paid. So what we're going to do is we're going to record the salary expense because we want to make sure that this is captured. It's December 31st. We want to make sure we're capturing it in 2020. So we have debit to salaries expense, but we're not paying them yet. We're not going to pay them, and sorry, dog barking. We're not going to pay them until Friday. So if that's the case, what I'll do is I'll create a liability for myself of salaries payable. All right. Now, when Friday comes along, oh, well, I don't get to Friday. When Friday comes along, the idea is we will pay this off. All right, we will pay them on Friday. That's when the cash will have a journal entry. But the point here is to make sure that the salary expense for Monday, Tuesday, and Wednesday gets recorded in the right period. All right, let's see if we get accrued revenues. This is kind of an easier one. Sorry, people coming home. As of December 31st, $10,000 of services performed during the year unbilled. Okay, so imagine you're doing a big job for somebody and you just haven't sent them the bill yet, right? They owe you the money, but you just haven't sent the bill because, maybe it's this big, long job and you just haven't sent it to them. So if that's the case, but we did the work, we want to make sure the revenue is recorded in the right period right now at December 31st, even though the cash isn't going to come until later. So if that's the case, we will record a receivable because we know they owe us the money, and we'll record the service revenue. All right, no cash is involved here because we're not going to get paid until whenever we get paid in the next year, but we want to record that $10,000 of service. All right, and here's where we go on to number 3.